Welcome to Phillip Futures Market Watch. My name is Chee Tat, investment analyst with Phillip Futures. Today we'll be looking at the recent economic outlook for US and China, since they are the world's largest and second largest consumer for oil. The US had lately extended the due date for the US budget and federal debt ceiling to January 15 and February 7 respectively. This would imply that the world may face another possible stalemate and risk in debt default early next year, which would lead to dampening global manufacturing activities and weigh down on crude prices. It is estimated that the recent 16-day US government shutdown had cut 0.25% off Q4 GDP growth and took 120,000 jobs from the US economy in October. With the current situation in the US economy, it is highly unlikely that there would be any reduction in asset purchases later this year. This would provide some relief to crude oil prices in the fourth quarter as a result. On the contrary, China's recovery seems optimistic. The manufacturing PMI is an indicator for the economic health of the manufacturing sector. A PMI of more than 50 represents expansion in the manufacturing sector, while a reading under 50 represents a contraction. The October China HSBC manufacturing PMI stood at 50.9, beating the Bloomberg estimates at 50.7. This value reinforces signs of economic rebound in China as there is an expansion in China's manufacturing sector. This is China's official manufacturing PMI. The difference between the two PMIs is the HSBC manufacturing survey is weighted more towards small and medium-sized enterprises, whereas the official PMI focuses on larger and state-owned enterprises. Since larger and state-owned enterprises are less vulnerable towards economic conditions, the official PMI generally paints a rosier picture than the HSBC PMI. The October China official manufacturing PMI figure stood at 51.4, beating the Bloomberg estimates at 51.2, another positive sign on the nation's recovery. Other China economic data releases are pretty in line with expectations. We see GDP year-on-year third quarter figure standing at 7.8%, which beats the second quarter year-on-year figure at 7.5%. Industrial production and retail sales year-on-year figures continue to post strong double-digit growth. As such, China's recovery is likely to boost manufacturing activities in the nation and provide support for crude oil prices. Next, we shall move on to the technical analysis for WTI crude oil. This is the 1-year daily price chart for WTI crude. We do see that prices broke below the bullish trend line, a possible bearish sign. The ADX below shows a figure above 20, which signals trending. As such, we may expect the build-up on downward momentum to take place. The current immediate support is at 92.5, while immediate resistance is at 102.5. If prices were to break below the 92.5 immediate support level, we can expect prices to test the next support level at 90. This is the same WTI 1-year price chart using different indicators. We do see a gradual divergence between the moving averages. The short-term green moving averages stay below the long-term red moving averages, suggesting downtrend to remain intact. The MACD is well below the zero level line in the bearish region, suggesting downtrend to prevail. In conclusion, fundamentally, US issues remain a concern that may weigh on crude oil prices. However, the downtrend pressures on crude oil prices are likely to be cushioned by recovery in the China economy. technically, we see the downside for crude oil prices. Phillip Futures offers trading in crude oil futures contract. For more information, please approach any representative from Phillip Futures for further discussion. Thank you and stay tuned for more Market Watch videos.